Hey guys, what's happening? It's CJ Investing here. Welcome back to my channel. And today we'll be doing a quick analysis on T. Rowe price. So before we get into it, I'm gonna need y'all to like, comment, and subscribe if you want to help me reach 100 subscribers, because that's my goal, is to reach 100 subscribers by the end of December 2023. We're at like 68 subscribers right now. Small channel, so we're trying to grow together as a family and learn together as a family and get those dividends. So if you want to help me do that, go ahead and subscribe and let's get into it. So we have T. Rowe price here on Yahoo Finance app. As you can see, its history is up. It's max like 15,000 or something crazy like that. As you can see, it's came up a little bit in price as the market has came up a lot. It's closer to this 52-week high right now of $134.64. Market cap of $28 billion. Is much smaller than BlackRock, another company that I love. But its dividend yield right now is 3.85%. So that's a nice yield. You're getting a nice safe yield. As you can see, some news. You can see company profile, the description. T. Rowe Price Group is publicly owned investment manager. The firm provides service to individuals, institutional investors, retirement plans, financial intermediaries, and institution enlarges and management equity and fixed income mutual funds. So that's all that I'm gonna read for now. It deals with a lot of retirement accounts. I'm sure many of y'all may know. The logo or the profile picture is the bull or the ram. I think that's a ram on it. But as you can see, it's financials for this is annually. As you can see, it had a great year in 2021 because, as you know, if you didn't know, T. Rowe price is tied to the market as well as BlackRock. It's tied to the market, and when the market does well, it does well. You know, based off of cash inflows and outflows. As you can see, the total revenue is gone up from year to year, as well as the gross profit. That's how much they're making, how much they're making after they pay their expenses, or the cost of the revenue. I mean, and we're gonna look at their shares. So as you can see, the most important thing about this, you just want to know they're paying off their shares. Their share count is going down, and they're not issuing new shares out on the market to dilute the investment, basically making you own less. So if they decrease the investment, as you can see, it's going down. It's gonna allow you to own more shares of their stock or company. Their earnings, as you can see, they've been beating on earnings except for Q2 of 2022, which is good. Every company's gonna miss a quarter or two. I mean, I'm not too concerned with the short-term headwinds. As you can see, assets under management, I got this off of the website. If you want to pause that and take a look at that. Total liabilities, total assets way outweigh total liabilities, so that's a great thing. They basically have no debt. So when you type up companies with no debt, this is one of the companies that pop up, and that's one of the reasons why I found this company. It actually led me to it. You can see is total debt to equity. You want that to be under 1, and it's recent. Debt to equity is 0.36. and that's really low. You're not gonna find too many companies out there with a 0.36 debt to equity ratio, meaning they have much more equity than they have debt. If the ratio was over 1, they would have more debt than they have equity, which is a bad thing. You don't want that, because as you see, their free cash flow is very important in the business to look for. You want to know that it's growing and that they have enough to pay out dividends and do share purchases, which they do. You're gonna have to excuse the noise in the background. It's raining currently where I'm at. I'm at the gym, but as you can see, the payout ratio is kind of high. That's something to look at. You know, keep your eye on. It's 79.87%. So yeah, that's one of the only things to keep your eye on. I believe their revenue will get better in the future as the market does better. You know, the market tends to go up. I think more people in the future are going to be investing. more mutual funds and more people are gonna establish retirement. So I'm very bullish on these different aspects of this company. Now I'm on the Fidelity app. If you didn't know, I use Fidelity brokerage account. I have a health savings account with them as well as a Roth IRA. They have a great interface, and yeah, it's pretty much the same metrics. 5 years. They had this big jump in 2021. I'm sure, as you can see there, the big jump in the middle when the market was, amazing. It was an amazing time to be in the market because everything was going up. But when everything balanced off, the stock came crashing down. So we're able to get a better deal on it than we were in 2021. As you see, it was founded in 1937. Baltimore-based T. Rowe Price Group is a global investment management organization with 1.4 trillion in assets under management as of June 30, 2023. Provides a broad array of mutual funds, supervisory service, and separate account management for individual and institutional investors, retirement plans, and financial intermediaries. The company also offers sophisticated investment planning and guidance tools. T. Rowe Price disciplined, risk-aware investment approach focusing on diversification, style, consistency, and fundamental research. So this is on their website, T. Rowe Price. You see their earnings calls, their forum, 10Q, 10Ks, stuff like that. Their stock as of this recording was $126.79. And now I'm on Seeking Alpha app, another great app. You see the 1 year dividend growth rate, 6%. 3 years, 13.39%. 5 years, 13.376%. 10 years, 12.89%. So they have great double-digit growing yields, meaning they're growing their dividend at double-digit pace, and they're beating the market just with the growth. So, and there's a lot of companies out there that can't say they're growing their dividend at a double-digit rate. I think, for instance, Johnson & Johnson is growing theirs in the single digits. Even though they're consistent, they get more dividend growth with this company and a higher yield with no debt, basically, on their balance sheet. So going forward, looking at the dividend safety, as you heard before, it's kind of high, within the 70s, cash dividend payout in the 80s. So they have that, but generally I think it's around the 70s, I believe, for the dividend payout ratio. Like I said before, they're going to get it down, I believe, in the future as their free cash flow goes up. Their payout ratio will go down. So I have a lot of conviction with this company going forward. These are just some metrics: dividend safety grade, and then we go on to, we're about to look at dividend history. So dividend history, consecutive years of dividend growth. So consecutive years of dividend payments are 36 years, and then dividend growth is 36 years as well. So what that means is they've been paying and increasing the dividend ever since the conception. Or they've been increasing the dividend ever since they've been paying their dividend, which is really great. You don't see that with a lot of companies, but with this one you do. And I just want to say I'm not a financial advisor. These are just my thoughts mixed in with some research, as you can see. And please do your own research before investing in the company. Don't invest solely off of what I'm saying. Go and see for yourself. And these are some last metrics. The earnings, they beat on earnings. They had a great earnings call, so you should check it out. But I love y'all, and until next time.